can I qualify without tax returns? Well, bank statement loans. I'm going to explain how bank statement loans work for my home buyers, just the regular home buyers who are entrepreneurs, or maybe you're not an entrepreneur, but you just have extra money that's consistently coming in that you're not filing taxes on. And real estate investors. And if you are a realtor, you must listen to this episode too, so you can understand how it works. If you do not, or even if you do know how it works, I'm going to tell you probably different things about the bank statements loan that you may or may not be aware of. So with that being said, welcome to the Home Loans Network podcast, where real estate deals are made, where we break down mortgages, real estate financing, and loan programs in a way that you can easily understand. I am Ebonie Beaco, your senior loan officer and mortgage strategist. And this podcast is designed to help homeowners, home buyers, and real estate investors make confident financial decisions, as well as realtors, real estate agents, for you all to be able to just work with your client, your buyer, your seller, so they can understand things even more. Because what if you're a real estate agent and your client is working with a loan officer or a mortgage broker who is not well versed in not just mortgages. Just because you take a loan, just because you take an application does not mean you're versed in mortgages. Understand that. Just understand that. It's important to understand the different programs that are out there, because even as a realtor, if you don't understand the different programs that are out there, or at least just understand a good loan officer from a bad loan officer, you will lose deals every single time. I'm here to make sure no one is losing deals. There's no guesses that's being made, no assumptions. Basically, I need everyone to have informed decisions, whether you're working with me, whether you're not working with me. So let's get into it today. With today's question, because I get this all the time, and I know many of you are listening right now are thinking the exact same thing. How can I actually qualify for a mortgage without tax returns, right? Well, here's the thing. Maybe you've actually been told no several different times. Oh, okay, yeah, your score might be 750. Yes, you have, $20,000 coming in your account every single month, $10,000, $60,000. Because yes, there are people that has a lot of that, and I can tell you personally. But sometimes, not all the time, but sometimes this money is not filed with the IRS for several different reasons, right? And sometimes people file only what they actually get from a 1099 or W-2 or any of that, but they don't file the Zelles that are coming in or the cash deposits that are coming in. If you have consistent cash deposits that you are depositing in your bank, all those maybe no's that you've been getting could have been a yes if you was working with the right person. Maybe you've been told that you didn't make enough money. Well, that's not true, because you and I both know, yes, you've been getting all of these side deposits that theoretically you make a lot of money, but your W-2s or your 1099s is saying something else. So tax returns, we're going to take that out the picture right now. So today I'm going to break this all the way down and show you how bank statement loans, remember that, bank statement loans, how they work, who they are, and why understanding them can possibly change everything when it comes to your buying power. And then, like I said, as a realtor, it's going to change everything about your business. So as we go through this, I want you to be able to visualize every single thing that I'm saying, because we are not on video and we're on audio. So I need you to visualize. And if you need to grab a pen, paper, please do so, because I am going to try my best to go as slow as possible. So don't just listen to anything that I'm saying. I need you to picture it, visualize it, and write it down. Now, why traditional income doesn't work for everybody? Like, I'm one of those people that traditional income doesn't work for me, because I have money coming in from so many different areas, or whether it's real estate, mortgages, and business consulting. I'm that person that potentially need a bank statement loan because, again, I don't care what you say. I'm not talking about me. Everybody doesn't file every single thing. So traditionally, when you apply for a mortgage, lenders want to see very specific documents, the W-2s, the pay stubs, the tax returns, right? Here's the thing. If you're a straight W-2 employee, that system may work fine for you. But here's the disconnect. A lot of high earning people do not make money that way. That is not where all of their money is coming from. It's not coming from a W-2 job under no circumstances. Even the CEOs generally tends to be some type of consultant, or they're doing speeches or speaking engagements, or they're doing trainings that's totally separate from their CEO position that's paying them a high, when I say high six figures, with probably stock shares and options and things of that nature. But understand, sometimes those speaking engagements are different checks that may or may not be reported. So with that being said, and the reason they got those speaking engagements or able to put on a seminar, a paid seminar, is because of their job title, is because of who they are and, you know, their name, their brand that they built for themselves, whether it was through their corporation they work for or not. But the reality of it is, a lot of high income earners, they do not make money off of just their W-2. So whether you're a self-employed, a business owner, a consultant, or an investor, your taxable income is often much lower than your actual income because you're doing what you're supposed to do. You're writing it off. You have business expenses, marketing, equipment, mileages, home costs, right? These are, and when I say home costs, like your home office, a lot of, you have celebrities or athletes that have gyms in their homes. Singers and rappers have studios. So that costs money. That can be written off, but then sometimes that may make a situation not the greatest. So on paper, it looks like you actually make less, even though your bank account tells a freaking different story. That is where the disconnect is. And that's exactly why bank statement loans exist. Some people know about them. Some people don't know about them. There are some that know about bank statement loans, but really don't even understand how it works. So now let's talk about that. What the freak is a bank statement loan? Let me explain this in just simple language for you. A bank statement loan allows you to qualify for a mortgage using cash flow instead of tax returns. Instead of asking a lender, what does your tax return say? Or instead of a lender, let me correct that. Instead of a lender asking you, what does your tax return say? They generally ask what money is consistently being deposited into your bank account. Typically, the lenders want to review 12 to 24 months of bank statements and bank statements whereas you have consistent deposits. Don't try to put one $50,000 deposit in there and all the previous months is $500, because see, now we got an issue right there because that's one huge, large deposit. Are you consistently having an average of the same amount of deposits every single month? That is what they're looking for, because then it's clear that you do have some type of other side business that you have. Then they're going to also look at outside of the 12 to 24 months bank statements, they are looking at the business statements, the personal statements. The average, the deposits are monthly. They're not looking at your W-2s. They're not looking at your tax returns. Why? Because sometimes you don't file that for several different reasons. But they are looking at just the real deposits, which is real live income that's consistently being deposited in that account. So who are the bank statement loans for, if you want to know? And don't think it's just for celebrities. No, absolutely not. Like I said, I actually mentioned me in here. I'm not a celebrity under no form or fashion. They're for your regular people, kind of, sort of. These loans are designed for borrowers who are income strong but paper light. Income strong, but their paperwork is light. That includes business owners, self-employed borrowers, consultants, freelancers, realtors, mortgage officers such as myself, who's also a business consultant, gig workers. Now understand this, you actually still may have a W-2 job, but you're doing freelancing on the side. You're doing consulting on the side. You're doing real estate on the side. Or it might be the real estate or the loan officer or the insurance agent is your full-time job, but maybe the other one is part-time, maybe because you want benefits, whatever the case may be. It doesn't matter. The fact of the matter is you have a lot of income coming in that's not being reported technically to the IRS, but your bank statement says otherwise. So yes, 12 to 24 months bank statements, start collecting them, because with that being said, you could potentially qualify for a mortgage as long as that credit score is intact. So if your income is consistent, but it doesn't show up neatly on the tax returns, this loan is actually built for you. Now, while someone actually may use a bank statement loan, now I need you to think about this, and I want you to visualize this. I'm going to paint a picture for you, because this is where people usually go, oh, wait a minute, that is me. So let's say you have a job making $85,000 a year in salary, $85,000 a year. And maybe you keep that job because it provides the benefits, it offers stability, it helps you offset your taxes, things of that. It helps you put that money in that 401k, that 6%, and the company match it. And maybe you say, you know what, screw it, I'll put 8%, but the company goes 6%, and you're not even touching this money. That's one less thing that you have to pay for. You don't have to pay for your benefits, your health insurance, the 401k, and your taxes are offset. So that's why you probably have that job. But that job serves a purpose. But now let's add the part where lenders don't always see clearly unless you show them. That same person also earns $200,000 a year in self-employment income. This might be from consulting, side businesses, commissions, investments, whatever it is. And that income is being deposited consistently in their bank account, whether it is from checks that people are writing them, whether it's wires, whether it's Zelles, whether it's Vimos, it doesn't matter. That money is being consistently deposited into their savings account, checking account, in their business account, in their personal account, whatever. But the real life situation, guess what? The problem is when it comes to traditional banks, that can be an issue. And that is where the gap in the bank statements loans, they are designed to fill the gap of the missing income. Here's the thing. I'm going to talk about DTI, debt to income ratios. And so I don't ever want you to get confused with this when we talk about DTI, right? Because remember that $85,000 in your salary, in that person's salary, then you have that $200,000 side money, right? When we start putting DTI into consideration, that person with that $85,000 a year salary cannot afford, I don't care if they don't have no debt, is not going to be able to afford a home for $600,000. Even at 0% interest rate, they're not going to be able to afford it. But that person that's making a $200,000, okay, they could possibly, we don't know how much they have in debt, but when you add that 285 with it, that's a whole nother story. So now let's talk about debt to income ratio. DTI. Here's the deals. This is how where deals are won or they are lost. And even if you are a realtor and you don't understand this and you are showing people properties without pre-approvals, shame on you, because you don't even know what they qualify for and they don't even know what they qualify for, and you just wasted your time. So like I said, DTI stands for debt to income ratio. It answers one question: how much of the monthly income is already committed to debt? This includes that car payment, that credit cards, student loans, personal loans, etc. All of that stuff. It doesn't include the new mortgage yet. And what usually comes with the mortgage is the taxes and insurance. And depending upon the type of property it is, if it's a condo, it might have association fees. Or if it's a gated community, it may have association fees. Or if it's a townhouse, it more than likely has association fees. So that income is not included in the previous debt that I just mentioned, which counts as part of your liabilities in the debt to income ratio. Now, there are the front end ratios versus the back end ratios that you need to understand. So a lot of times you'll have a lot of people that are out there like, wait a minute, I make $300,000. I can afford this. Yes, hold up, Charlie Brown. The problem is you probably really don't, because you have so much debt that you can't. I don't care even if it is a lot of side income coming in. Understanding your debt to income ratios will play a part in what's the potentially needs to be paid off. So your front end ratios looks at housing only. Your front end ratios look at mortgages, what the mortgage payment is, taxes, insurance, and HOA fees, right? The typical guidelines for FHA, which is the Federal Housing Authority, is around 31%. Conventional is generally around 28%. Then you have the back end ratios. So the back end ratios look at everything that is combined. It's the housing pulled in with all of the other debt, which means, like I said, all the other debt, right? The FHA is 43%, and those what the guidelines are. Generally, it doesn't matter whether it's a bank, mortgage company, wholesale lender, correspondent, it doesn't matter, okay? That's what it is, because usually when these loans get sold off to another bank or investment group, guess what? Everybody's still going through the same guidelines, because they need to make sure that if they buy this buy your loan, you're not going to default on them. Once you understand this, the mortgage process stops feeling like so random. Like it's easier for you to know what needs to be paid off, what don't need to be paid off, if you need to work a little more, if you need to find some more side hustles. I don't care. But you need to understand this. So I want you to, let's run some numbers right quick, right? Let's grab a pen for me. Pause this. I'm going to keep going though. Let's take an interest rate at 5.75% interest, right? So here's the scenario. Your home that you're looking at to put an offer on is $600,000. The interest rate is 5.75%. 30-year fix. 20% down is what you're doing. So it's 80% loan to value is what they're actually going to lend you. So they're going to lend you 80% of it, which is $480,000. And you have to come up with that 20%. Now, all of your other monthly debt is $3,000. So think about this. At 5.75% interest rate, the payment is about $5.84 per $1,000 that you borrow. So let's break this down. $480,000, which is the loan amount, divided by that $1,000 that you borrowed equals $480. 480 times that 5.84, which is basically the 5.84 per dollar of the $1,000 that you borrowed, equals $2,803 in principal interest. So this is how you calculate this, okay? Now you want to go ahead and add the taxes in for $800. So we're estimating the taxes at $800. We're going to estimate the homeowner's insurance for $200, okay? Now the total housing payment is going to average $3,800. This is for someone who's purchasing a house at $600,000, 5.75% interest rate, 30-year fixed, 20% down, with a loan amount of $480,000 and monthly debt of $3,000. Like I said, they principal and interest $2,803, but after the taxes and insurance, it came out to be $3,800. Here's the problem though. That's just that. We have not included the income. Now, I'm going to give you example number one, which is the salary only. If someone is making $85,000 with a monthly income of $85,000, when you divide that by 12, that's $7,083. We haven't even talked about the fact of taxes and insurance that's coming out of their check. So let's leave that alone. We're sticking with the 70-83. Front end ratios, when it comes to the DTI, you take that $3,800 a month housing payment, you divide that by $7,083, which is their monthly income, and that gives a back end ratio of 54%. They do not qualify because if you remember, I said the back end ratio for FHA is generally around 43%, and for conventional 36 to 45%. So they already can't even get that house. They don't even qualify. Now, we're not going to waste our time on that. So that same borrower, same house, same rate, but that number is not going to work for them. Now, let's take that same person who makes $200,000 on side money, right? Not their $85,000. They decided they don't want to include the $85,000. They could, but for this sake, we're not going to do it. $200,000 bank statement loan. So $200,000, divide that by 12. That's $16,667 of what they make for their monthly income. Their front end ratio, if you take that $3,800 payment, divide that by $16,667, you're looking at a back end ratio of 23%. You remember what I said? FHA is 43%. Conventional generally is 36 to 45%, just depending upon the bank, the mortgage company, the investor who's actually looking at that. That person actually qualifies. So understand that if this is done right, bank statement loans are the bomb. Like, if I turn around and take that same person and say, okay, you know what? Now let's just go ahead, for the sake of this, include both of the incomes. Well, we clearly saw that they qualified for the bank statement loan with the $200,000. So at $285,000, if they wanted to get that same house, of course they can get it. There's no doubt about it. But for the sake of learning how to calculate this, you're going to take the same income of $285,000. We're combining both of them, the salary plus the side money that comes in, whether it was from presentations, speeches, seminars, whatever, consulting. That money, once you turn around and divide their $85,000 by 12, that's $7,083. That's their salary income, right? And then you turn around and take that $200,000, which is their self-employment, divide that by 12. That's $16,667. That total comes out to be $23,750. Front end ratio 16%, back end ratio is 29%. It doesn't even make no sense for me to even go back to tell you what the difference is with the ratios, because we already knew that they qualify, but they're now on the lower end, which means it's a possibility their interest rate is going to be even lower too. This is a very strong approval. This is a type of buyer you want to take out because you got their pre-approval, like you know what you're dealing with. Now, what actually changed? Nothing. Nothing about the borrower changed. Nothing about the house changed. Nothing about the interest rate changed. The only thing that changed was the documentation that was presented. That's it. The reason why all of this is really important for all parties to know, whether it's the real estate agent that's involved, the buyer, the seller, your loan officer, is because when you understand how this works, you stop guessing, you stop stressing, assume you don't qualify. And a lot of times, if you assume you don't qualify, the dream of home ownership or expanding your real estate portfolio goes down, or the dream of your borrower and buyer is not going to qualify. It kind of puts you in a mood whereas it's like, I only want to deal with these type of borrowers. I only want to deal with these type of buyers. And you know what? More people can qualify than you can even really imagine. So let's not think that individuals can't qualify. Instead, you need to start asking better questions and making smarter moves before you apply, before you start working with someone, before you even take an application. So I just want to do a full recap. Here's what you should always walk away with when it's me, but right now, what I need you to walk away with. Bank statement loans are used for real cash flow. They're designed for non-traditional earners. That debt to income ratio matters. So this is not just stated income, stated assets, stated. No. We're not doing stated income, stated assets. We're only doing stated income based upon the bank statements loans, because in this case it's verifiable. The stated income, stated assets, that's when you just stating stuff because your credit score is so awfully good, and not many people even do that anymore. So you just have to work with the right mortgage loan broker. And the reason I say mortgage broker is because usually mortgage brokers work with multiple lenders and private equity lenders and investors that can get these deals done. But it's definitely important for all parties to understand this. Like I said, the debt to income ratio matters. The front end and the back end ratios matter. The income strategy, how this is going to be done, matters. The information that's going to be provided matters. So if I don't do nothing else, I want to leave you with this. You are only good as your information. You are only good as your information. I have a friend that tells me that all the time, and we do business. You are only freaking good as your information. If you don't understand how lenders view your income, you're always going to feel behind. And honestly, you're going to fall behind, or you're going to get cheated and screwed over. You're only good as your information. This is why you're listening to this podcast. So for you, you need to understand the rules so you can plan correctly, you can prepare, and you can put yourself in a position to actually win every single time. So if you're a home buyer, business owner, investor, or even a realtor, and you have questions, you want to know how your client can qualify, how your borrower and buyer can qualify, how you can qualify. Am I using the right income? Is a bank statement loan for me? Please reach out to me. Like, let's walk through this together. Yeah, I'm licensed in 11 states, but there's other states that I'm not licensed in, but I have no problem just talking to you. Reason being is because guess what? You're only good as your information, and networking is everything. And that's exactly why I love doing this podcast, because I can share the information that I know and I've been blessed to learn. So with that being said, feel free to visit my website at homeloansnetwork.com. You can always call and text me, ask me questions. I don't care. 312-392-0664. Send me a message, even through, whatever streaming channels that you're listening to. Otherwise, if you don't do anything else, subscribe so you will never miss any future episodes where I will always break down any real estate mortgage questions, scenarios, just to the point that you understand it, because I love doing what I do. And I want you to be able to make confident, informed decisions. Thank you for listening to the Home Loans Network podcast, where real estate deals are always made. And make sure you tune in every Wednesday on YouTube live at 7 p.m. Central Standard Time at the Real Estate Deal Room. Bye-bye.